Good evening, everyone, and welcome. My name is Ed Frezza, and tonight we're hosting the TESA's Multiplex Development Pro Forma webinar. This is part two of our two-week series on feasibility analysis. Last Thursday, we discussed the three elements that leads to today's segment, which is the actual Excel financial analysis. And what feeds into this financial analysis are three elements. Number one was the policy layers and the zoning. So we would look at things like heritage and archaeological and the actual zoning and FSIs and all that wonderful stuff. Then we would look at the massing that would allow us to figure out how many square feet, how many floors, where would this building sit on the lot itself, what kind of setbacks would we have. And then from that, we would look at the market rental study, which understands what kind of rents can we generate from the property, given its location, given the specifics, the socioeconomic demographics of the tenant population, where the property is located. When we take those three elements, now we can go to part two, which is drop those numbers into the financial analysis, and that will give us the metrics that we're looking for, things like IRRs, equity multiples, cash on cash. How much equity do I need to start this project? How much equity will I leave in the project? So that's the essence of tonight's webinar. To get started, because each time we host these webinars, we have a different group of people. So what I want to do is give you a little bit about my background so that you understand what I do and why I feel that I have the expertise to be able to talk about this subject matter. And then secondly, also about our company. We have four different divisions that feeds this information into the pro forma, and I think that's relevant. So giving you context of that before we delve into the actual presentation, I think will be worthwhile. So again, my name is Ed Frezza, and I started in real estate when I graduated from university. So I did a Bachelor of Science in Pharmacology and Physiology at U of T, realized I didn't really care for sciences, so I got an MBA in finance. And when I graduated in 1989, I got into a company which was the real estate arm of a pension fund company. For those of you who remember 1989, it was a peak of the real estate market back then with Ronald Reagan. He introduced a lot of liquidity in the marketplace, and so real estate really took off. And I got in at the peak of the market. And about 4 years later, with the Great Recession, our entire real estate department got let go, about 30 people. I was one of them. And so at that point, I decided to become a real estate broker. So that is something that I've been practicing ever since. And I realized that even though I enjoyed transacting properties and working with clients, I really had a hankering for owning my own portfolio. So in 2003, I started with my very first property, single family home, eventually triplexes, fourplexes, and eventually the largest property that I now currently have, 4-story, 31-unit apartment building. So I'm coming to you from not just as a broker, as a investor, but as a landlord with real world experience in landlording, in buying, selling, renovating, building, etc. Along the way, I thought of giving back, and that's when I joined TDSB, Toronto District School Board, in teaching real estate courses, real estate investing, pre-construction condo, and then the last couple of years, last year or so, in missing middle. So we also host these courses in-house. TESA has its own in-house real estate development course specifically in the missing middle. We hold a 6-week course on Sundays typically. If this or TDSB courses interest you, please send me a quick email. I'm happy to share details and hopefully see you in one of the classes. In terms of the company itself, TESA has 4 different divisions. We have a real estate brokerage side, we have the capital side, we have the development side, and then on the manufacturing side, we have something called TESA Skeleton, which is light steel framing. And I'll go into each of the 4 divisions individually. Right here. So TESA Real Estate, we are a commercial real estate brokerage firm. How that differentiates us from a residential brokerage is that commercial real estate is very much numbers oriented. It requires a lot of analyzing the numbers to understand what you should put in the model and what comes out of the model. So even though there's still some emotions, because we human beings are emotional beings, there's still an element of emotion in buying and selling commercial real estate. There's a more analytical element than, say, buying a single family home. So what we bring to the table is the analysis, and I'm going to give you a close look at the analysis that we do on a typical transaction. So we're involved in land and development, multifamily, but we also do selective residential. On the capital side, specifically with regards to financing, there are three elements of financing in any development. First of all, you have to acquire the land. Secondly, there's a construction financing. And thirdly, there's the takeout. What's unique about the missing middle is that you have something called the CMHC MLI Select. And that's really the grease that makes all this happen, because it facilitates missing middle development in that it gives you up to 95% loan to cost, up to 50 years amortization, and a below market interest rate currently at about 3.9%. So those things in unison, along with Bill 23, which has relaxed the zoning laws to allow greater gentrification in the Inner Toronto area and all of Ontario for that matter. Those two elements has made missing middle a lot more attractive. So we understand the financing side, and that's another element that we bring to the table. So when it comes to the financing element in the pro forma, having real world experience by helping our clients get that financing allows us to input real numbers. On the development side, that involves the entitlement, which is to say, what can we build on this property? Are we going to build as is, or are we going to try and push the envelope to some extent by going through some sort of a minor variance through committee of adjustment? And then, of course, applying and securing the building permit, as well as the actual construction. So that development aspect is something we're very entrenched in. And last but not least, as I mentioned, we have something called TESA skeleton. And this is basically in response to the fact that as we build more and more units in an apartment building, you can appreciate that the risk for potential fire is greater. You have more people in a building, fire prevention becomes even more important than, say, a single family home. So one of the regulations is that the load-bearing walls have to be of non-combustible material. Certainly you can use poured concrete or cinder block and a number of other materials, but what's becoming increasingly attractive is this thing called light steel framing. And I have some examples and pictures, but we have in-house manufacturing. So if you come to us with your structural drawings, we can actually quote you on that. In terms of the number of projects we've done and the types of projects we've done over the last 10 years, you can see that on the left-hand side, we've got a roughly 10,000 square foot custom home that we're building right now. We've done additions, extensions, garden suites. We've done retail, clinics, office build-outs, gas stations, industrial. But as of last year, we have focused on missing middle. We have pivoted, as many other developers have, because the missing middle is becoming kind of the next iteration of Toronto's development. We all know what's happened to pre-construction condos. We know that building custom homes on spec, that doesn't work anymore. So more and more investors and custom home builders and other developers are looking at the missing middle as the next iteration of Toronto's redevelopment, if you will. So we're on the left hand, I'm showing you a 12-plex with a main floor retail that we're working on. We've got a roughly 65-unit apartment building that we're working on as well. So like many others, we are pivoting to the missing middle because this is where we're seeing that there's a built-in ready need. It's not speculative in nature. There's a tremendous housing need right across the country. Toronto is no exception. So here's an example of what this LSF framing looks like close up. On the left, we've got just a model, if you will, measures roughly 4 feet by 4 feet by about 6 feet to the peak. And on the right side, you can see a close-up. You can see it's held together with screws, and there's divots so that the screws are flush. So when you put a drywall sheet over it, it's not protruding, it's laying flat. And this is a material that we can produce, customize and delivered to your site, much like, a skid of 2x4s, for example, would be, or we can actually panelize it in-house in our facility, in our manufacturing facility, and then truck it to your site, in which case it's just erected on site, and that saves in time and increases the quality of construction. In this example, we're seeing this is actually that 10,000 square foot custom home that we're building. You're seeing the load-bearing walls. On the exterior, of course, that's the load-bearing walls. That column in the middle is the elevator shaft for this two-story home. This is an example of what the machine looks like. It's got an input screen where the technician would input the details of the elements of the structure. You see a series of rollers, each compressing and changing the form of the steel. You can see on the left, you've got a roll of the raw material of the steel, galvanized steel. Comes in different widths, different thicknesses, and it's fed into the machines, and of course the rollers and hydraulics shape it into form. So in terms of our overview of what we provide, basically we provide the whole gamut, the whole services, with the exception of the legal and accounting. So from capital structuring, the financing, specifically with CMHC MLI Select on the takeout, but also with the CMHC financing for construction. We can help with the site acquisition and due diligence, the entitlement, which is the zoning and policy review, and the massing. With the design team, we can assist with the LSF design, submitting and securing the building permit, the construction and/or project management, and then of course stabilization to find suitable tenants for the property. And then once it's fully leased up, then of course we can approach CMHC and get the MLI Select takeout. At this point, I'm going to stop sharing this screen, and we're going to switch over to the actual Excel spreadsheet. So as I mentioned when we first started, last week's session was talking about, if you've got a parcel of land, what can we build on it? And the answer to what can we build on it is influenced by what is the zoning and what are the various policy layers that defines what we can build on it. With that, we then can define what does the massing look like, which is to say, what is the biggest or most suitable cube that we can build on this lot, being respectful and mindful of height restrictions, of setbacks, both side, front, and rear setbacks, et cetera, et cetera. With that hypothetical box, we can then figure out how many square feet, and that becomes relevant because now, obviously, knowing how many square feet we have to build, we can cost out the hard and soft costs. But then also knowing how many square feet we have, we can then figure out how many of those square feet are net leasable, because we have to make allowances for things such as staircases and corridors, for example, which obviously we cannot generate income from unless, of course, those corridors and staircases are within the actual apartment rental unit. So there's two different GFAs, or two different square footages. One for calculating the hard and soft costs for construction, and then the other one will be for the actual leasing revenue. So we start off at the upper left of the screen. Yeah, thank you. Just make it a little larger. So of course you got the project name. We've redacted the street address just for confidentiality reasons. Again, this is an actual financial analysis. We did not make this up. This is actually one that we actually use with a client, but we've redacted all confidential information so that obviously to protect the privacy. You can see that on the analysis start, which is E13, we're starting with June 1st. Why? Because there's no point starting May 1st. There's always going to be a period of time that clients approach us and they're either looking at potentially buying a property or they've already bought a property. So there's a period of a lag period. So we'll pick a month in the future. June 1st is a good place to start. The next is the pre-development duration, entitlement. Now this changes based on what are we we going after? Are we going to play it safe and go as of right? Meaning if we are in an RD zone and we're not in one of the 9 wards that allows 6 plexes as of right, we can do a 4+1. That's to say a 4-plex with an AD, an accessory dwelling unit at the back. So you might decide to do a 4+1, or are you going to go for, say, a 6+1 or more? So that will change the entitlement process. If we're going for just basically as of right, 5 months is a fair amount of time to do that. If we're going for something that requires a minor variance, we might go for, say, 8 months. And of course, that all depends on a case-by-case basis. So that number very much is influenced by what we feel is going to take, what is the amount of work required, what hurdles are needed to achieve what we're trying to achieve, and that will be reflected by the number of months we put here. So here we've got 8 months because we are going for committee of adjustment with a minor variance. And that is not our doing. This is a direction from our client. So the client will very much determine in which direction we're going. We would have done a financial analysis with them, both on an as of right. We would have done a financial analysis as of with a variance, and they would have made a distinction of, is it worth the time, the effort, the risk to go and chase a minor variance, knowing that it's not guaranteed, even though there's a high chance that it probably would be granted. So that's what the 8 months and how the 8 months is calculated and inserted. So automatically it then it gives you the date of the construction date, because if we know when we're starting, June 1st, and we know there's going to be 8 months of entitlement, that means on the 9th month, which is March 1st of 2027, would be the start of the construction. Now, how long is the construction? Again, it depends on what we're building. Is this a 2-story, 3-story Part 9 building? Is it a 4-story plus Part 3 building? So the number of GFA, the number of stories, etc., will determine the 12-month number. It could be slightly shorter. It likely will be at 12 or longer, depending on, again, the size of the building. The hold period will be 5 years. Now, why do we do that? Well, as I've probably mentioned in previous webinars, if you've been listening to these webinars, a lot of these missing middle projects do not follow the conventional development model, meaning in conventional development, you would expect to be able to make a significant capital gain on completion and then be able to sell it. Unfortunately, a lot of these missing middles do not pencil out in that way, meaning if you buy a traditional, typical, say, $1 million lot, you spend $2 million on hard soft to develop it, you're in for a $3 million project, maybe it's worth 3.3, maybe it's worth 3.5. $500,000 by the time you pay taxes may not be worth your while to go through that effort. So that's why a lot of people hold on to it. So in our analysis, we start from the point that you either buy the property or maybe already have it, the entitlement, the construction, and then a 5-year hold. So in this case, 8 plus 12 months, that's 20 months. Plus the 5-year hold, 5 years is 60 months. So 60 plus 20, that's an 80-month hold period. And the metrics and financial analysis that I'll show you at the end reflects an 80-month hold period. After those 80 months, it's deemed to have been sold. Doesn't mean you have to sell it, but your 5-year mortgage with CMHC CMHC insured mortgage will come due. And at that point, you have the option to sell or to refinance, whatever. So that's the typical period that we analyze all of our deals. So that's where the 5-year term comes from. Now we'll move to the right side of the page, and this is where we start inputting the rental income. So from our massing, we would have known how many square feet a floor plate is. We would know how many floors we have, and this is where we kind of figure out roughly, are we going to do 1 unit per floor? Are we going to split it in half? How many square feet are we going to have? So again, I made the distinction earlier between the gross floor area, which is basically from the outside wall to the outside wall, which is useful for construction budgeting purposes. However, when we're looking at the leasable space, obviously it'll be less because now we're measuring from the inside wall to the inside wall of just the unit that's being rented. So this is where you'll see a difference between as you see in the screen, they're highlighted 6,066, which is what we're actually being able to charge rent on, versus a 7279, which is the figure that we'll use in our budgeting for hard soft costs. So in this particular case, because of the square footage that we had on the floor plate, and because of what we know for the area, it was deemed that the 3-bedroom would be the most suitable fit, and we were able to fit an 811 square foot on this particular one. So it's 3 stories, 2 units per story. So 3 times 2, that's your 6 units. They're each 811 square feet. Market would suggest about 3,000 square feet for that 3-bedroom unit. You can see on the far right, we have then it broken down into a dollar per square foot per month number. Now, what's the relevance of that? Well, that's like a sanity check. So if we're using numbers and it turns out that we're looking at $5, $6, $7, $8 a square foot, we know right away that we're out of whack. The numbers just don't make any sense. So it's kind of a check and balances in place that we can eyeball that number. We know that the average in Toronto is typically in the sub $3 category, in the high 280s, 290s. But that's a very rounded, very general number. When we're looking at garden suites in really nice areas, or you're looking at smaller units, typically the price per square foot per month goes up. $4, $4.50, $5 would be at the higher end. So knowing that range prevents us or protects us from putting numbers together that just don't make any sense, that are not supported by what's happening out in the marketplace. So we have the square footage. We have done our analysis, market analysis for the area to understand what the rent per month is achievable. And then the far right there does the math and keeps us in check that we haven't picked a number that makes no sense. So we've got 6 units. They're all the same. If we had a variation of units, meaning we had, say, some 1 bedrooms and some 2 bedrooms per floor, we could then on the left-hand side indicate it. So you can see we've got basement, 1 bedroom plus 1 bath. Well, we haven't got anything in the basement. So here we're building 3 stories above grade with 2 units per story with an unfinished basement. And then we've got a 3-bedroom garden suite of about 1,200 square feet. I think 1,290 is the largest you can build, which is 60 meters squared. We've put 1,200 and we're getting 3,500 for that. Again, garden suites typically can generate more than that rent, but what we're trying to do is show a conservative number. And once we've done this analysis, we then sit down with the client, and the client typically knows the area very well. In many cases, they've owned the property for many years, and they're able to fine tune these numbers, say, you know what, I know for a fact that we can get more than $3,500. I think we can get $3,900. At that point, we would then change the $3,900 as per the client's request, and then we would see what those changes make. So if I could ask you to change that to say 3,900, actually, sorry, go back to 3,500. So I draw your attention up above to the yields. So this is the last thing I wanted to talk to you, but since we're in this section, I wanted to show you the yields that are generated by this particular project are as follows. So on the upper left, you have development yield. This basically says, if I take my net operating income and divide it by the project cost, what am I getting? In this case, it's a little less than desirable at 4.58, because ideally we want to see it in the 5 to 7% range, which kind of acknowledges the fact that we're doing a development. This is not buying an existing building. There's a bit of risk that we want to be compensated for. So you can see that at 4.58, we're a little on the light side. We also then do an analysis of the exit year development yield. So this is after 80 months, both unlevered and levered. Now, why do we do both? Because the levered will show what we actually are getting. That's the actual number, because a lot of these projects are done with the use of some level of debt. They're not done with all cash from the developer. There's some element of financing, and it makes sense because you're making money on borrowed money. So it makes sense mathematically, and so that's one of the advantages of real estate is you can actually use the asset to borrow against it. But we use the unlevered number to say, hey, if we take financing out of this, what does it look like? In other words, we don't want to use cheap money if we were building in a very, very easy money period, which right now is not so easy. But if we were in a peak of our real estate market when it was really easy to get financing and financing was cheap, that would skew the numbers. And so we use the unlevered to make sure that it still works. So we want to see the two of them. So now that we know that the profit is 1,117,000 levered, what happens if we change the garden suite now from say 3,500 to 4,000? What changes? See what happens to the profit. You can see it went up from 1117 to 1233. So what my point is that this financial spreadsheet is very dynamic. You can start doing a sensitivity analysis to say, well, what if I can get an extra $100 on rent? How sensitive are the numbers? You can see that the IRR for the levered is 14.63%. Typically, the rule of thumb is we like to see around 15%. So between the 14.63 and a development yield of 4.68, we're a little bit on the light side, but that just suggests that, hey, this is a deal that's worthwhile exploring further, rather than throwing the baby out with the bathwater here. We want to take a closer look. It's worthy of further exploration. The client might have other reasons to go forward with this deal, even though the number's not ideal. Maybe they own a few properties in the street or in the area, and it would be easier for them to property manage afterwards. We don't know. But this is how we generate the rental income, the gross rental income, from which now we're going to subtract a vacancy rate. Now, the vacancy rate is something that's stipulated by CMHC. Again, CMHC has the money. He who controls the gold makes the rules, right? So we have to abide by their guidelines, their sandbox. And some of their guidelines is we're going to use a 3% vacancy allowance. So we got to subtract 3% from the gross rents. Even if we have 100% lease up, they want to see that vacancy allowance, and that generates what's called the effective gross income, the EGI. So here we can see that it's 255 grand. Before I leave this, I just want to say that we also have included parking income and storage locker income. Again, if those of you have listened to a number of our webinars, you realize that, or you recall that I have mentioned on a number of occasions that $100 in rent on one unit equals 30 grand. How does that work out? Well, if you take a $100 increase from just one unit, $100 times 12 months is 1,200. At 4 cap rate, for example, for easy math, that generates $30,000 in value creation on the property. So this is why in developing these properties, we're trying to look at any and all ways that will allow us to optimize the income from these properties. So charging for parking is one way, charging for storage is another, charging for bike racks is yet another. So this is where developers are getting very creative and trying to figure out how to optimize the income that's coming from the property, because there is a tremendous leveraging effect. So having said that, 263 is the gross revenue. Subtract the 3% vacancy, leads an EGI of 255. So now we go into the expenses, and these expenses, again, because we're going to go knocking on CMHC's door, they're going to say, hey, if you want to take out financing CMHC MLI Select, you have to have numbers that meet the following criteria. And we basically have taken their numbers. And so, for example, very top line, property management, 4.25% of EGI. So if you approach them and say, oh, I've got my own property management company and we're using 5%, they're going to take the higher of the two numbers. So now we would have to change that 4.25 to 5%. So you're well advised to make your numbers reflect what is obviously going to be more beneficial to you. Salary, wages, even if you don't have any, they're going to want 555 pupa per unit per year, per annum. So if we've got 6 units, 7 units here, 7 times 555 generates the number. Repair and maintenance, you might say this is a brand new building. What possible repair and maintenance might we have? Doesn't matter. They want an 830 per unit per annum allowance, utilities, capital replacement, so on and so forth. And so after you subtract all the expenses, you come up with an NOI, a net operating income of 198,451 at the bottom. 198,451. So roughly 200 grand is what we can expect after stabilization with full lease up from the property. So now we'll go on the left side and we'll go up a bit. And so you can see here in terms of the development sources and uses. So we're going to need about 4.355 million for this project. And CMHC says, hey, I want to see that you've got some skin in the game, and we want to see about 30%. So 30% of that 4.3 is 1,336,000. Now, as I'll show you, in this particular case, the property was valued at $1 million. On top of that, of course, you've got land transfer tax and you've got legals, et cetera, et cetera. So that shows up as 1,059,000 right there at the bottom there. Correct. Yeah, that's highlighted. So 1,059,000, but from the 30% rule, you need 1.336. You can see that we need almost $270,000, $277,000 on top of that. So after this particular client has bought the property for cash, they need to infuse a further 277 grand, typically in the form of entitlement service costs. So the engineering, the drawing, the building permit fees, all these fees in aggregate, adding up to 277,000, leading to the point of having the building permit and being shovel ready. At that point, the construction financing, whether you go private, conventional, or CMHC, will take over. But this analysis shows you that, hey, if you were to build this building of so many square feet of 3 stories with the following units generating the following income, you need the following equity to make this happen. So you can see how this is starting to show and put some meat on the bone and give you some direction of what you need, timelines, what you need equity, but also to show you what the equity you have to leave in the deal. And so if we just scroll down a bit, you can see that line 76, the stabilization is 4.349. So that's basically taking the NOI and calculating the valuation from that. And of that, we're going to get 3.697 in loan, which means about 758 grand is what you have to leave in the deal. So even though you needed 1.336 million in the deal to make this happen, you're leaving 758 in the deal at the point that you're getting the CMHC MLI Select 5-year takeout mortgage at the end of construction. And they cut you a check for 577. So the 758 and the 577 essentially is the 1.366 or so million that you have in the deal, right? So this is how these numbers start to pan out. Up above there on line 62, we're showing that you've got a construction financing. Typically it's 4%, so that's $108,000 fee that you'll be paying, prime plus 555 basis points. That's what BIPS stands for, basis points, 5.55%. And then the 85%, CMHC MLI Select allows up to 95% loan to cost, not 95%, up to 95% loan. And how do you determine if it's 80, 85, 90, whatever the number is? Well, if you go to the bottom there at 1.10, that's a DSCR, or debt service coverage ratio, which basically states, hey, I want to lend you money because that's how we make money, but I don't want to get into trouble by lending you too much money. So what is a safe number? Well, we're going to impose this rule of 1.1, meaning for every $1 in mortgage commitment you have to me, I want to see that you have at least $1.10 in net income. So not only do you have enough money to pay me my $1 in mortgage commitment, but you still have 10 cents left over. So should you have any vacancies, whatever, it more than covers. So that 1.1 is crucial, and that works backwards, and that's how we get the 85%. Because let's say if we change that to 95%, you'll see what happens. you can see that that 1.10 dropped to 0.98. So now being under 1, we don't even have enough money to cover the mortgage. We're short 0.02. And that would not be cool with CMHC because they want to limit their exposure. And one way to do that is to ensure that we have adequate cash flow. So that's how that 95 gets moved down based on how much income you can generate for this property, which takes me back to my comment about parking and about storage and other ancillary service that you as a developer landlord can bring to the property to improve or enhance the cash flow as much as possible. So we've returned the loan to value at 85%. Current rates are 3.9%. You would have a 3% loan premium, which gets tacked onto the mortgage amount. So that doesn't actually come out of your pocket day one. 40 years, again, you've heard me say that CMHC MLA Select goes up to 50 years, but that depends on, usually here in Ontario, on the degree of energy efficiency. So in this case, we went for enough points to get us to 40 years. And even with 40 years, you can see the numbers still make sense. So from here, where I want to take you is to the monthly cash flows to give you, I guess, behind the curtain look at how these numbers all kind of come together. So on the monthly cash flows, you can see on the left-hand side, we have the various categories. So the first one is current land value, which is the land value, the land closing costs, et cetera, et cetera. You can see there's a start month and an end month. And so we allocate when the money will be basically used. So you can see the construction element there where we've got demolition costs. Well, demolition doesn't start until beginning of construction in month number 9, line number 44, for example. So that cost is 60 grand. It gets used up in 1 month in the 9 months. So what happens is we've got all 80 months of the analysis, and so in month 9 we would have the expenditure of that 60,000. So why is that important? Because we are in the IRR calculations factoring the time value of money, meaning money spent today is not the same as money spent 10 months from now, 20, 30, 40 months from now. So we have to allocate that. And so all the elements of this building, the land acquisition, the soft costs, the entitlement, design engineering, the hard costs, all of them are given a time at which the expenditure happens. So we can scroll over to the right now, and we'll show you the first 9 months or 8 months and how that is. So you can see at the very top, you have 0, 1, 2, 3 at the very top, and that refers to the months, and it goes all the way to 80, because as I mentioned, we have 8 months of entitlement, 12 months of construction, and 60 months of holding. So that's 80 months. So we go through the whole 80 months, and the first 8 months is the entitlement, and then 9 months, 9 to 20, is where we're spending the big chunk of the cash for the actual soft and hard costs, really the hard costs. And so these numbers are then kind of used to do all the calculations behind the scenes. So I won't drag you through all that stuff because it's pretty dry and boring stuff. It's just Excel stuff. But we'll now go to the annual cash flow tab. And this one's interesting because it kind of condenses everything, and it's a bit more interesting. So you can see year 0, nothing happens. Year 1, we spent money on the land, we spent money on engineering, et cetera, et cetera. Year 2, we finished constructing. And year 3, part of year 2, and then year 3 for sure is the beginning of the hold period. So you can see the first year there's 53,000. Why isn't that closer to 258 or 266 that you see in years in the following 2 years? Well, it's because the first year is an incomplete year. It's not a full 12 months. So again, we did entitlement for 8 months, construction for 12 months. So that's 20 months. That means the last year is only 4 months. So 53,000 is roughly, a fraction of the 258. So you can see you've got 1, 2, 3, 4 full years, and then 2 years on either side that are partial years. And that's how we calculate the holding period cash flows, and then how we calculate the sale at the end by looking at the 6th year net income and applying a cap rate to derive the suggested sale price. So you can see also how the DCR or DSCR changes. It starts off at 110, which is what CMHC dictates. So we start at 1.1, but as rents start going up and you start paying down the mortgage, you can see how the DSCR starts to increase, 1.13, 1.17, 120, 124. So you can see the time, the power of time in these projects, which is one of the reasons, the main reasons why a lot of people opt to hold on to them, because the longer you hold on to them, the more the gravy they start to spin off. If we just go back to the assumptions, summary assumptions tab, yeah, and go to the very top. So you can see again in summarizing this project, it has healthy returns. It's not ideal. It can be a little bit better, but this is where we can then tweak with the client the rental rates. We can also perhaps change things around. Now, I mentioned the basement is unfinished. At some point, if the city along its path of gentrification starts to relax the laws, the rules, the policies even more, allowing for the basement to be created, to be built out, you now could change this 6+1 into an 8+1, for example. So there's some gravy in the structure baked into the development for this developer, this client. So this client might decide, you know what, I'm marginal on my returns, but I have those 2 units that at some point, hopefully, with the changes in the way things are happening in the city, I'll be able to build them out. And since I've already got that space, it's just a matter of 100, 200 grand for build outs, and that'll significantly improve my cash flow and significantly improve the valuation and put me over the top. So this is kind of an overview of how we analyze these deals and how, along with our clients, they come to a determination whether they decide to go, no go. Basically understanding the full scope of the projects, from the timelines to the costs to the spending of the money over the 80-month period, to the equity requirement going in, to the requirement or how much equity they're leaving in the deal at the tail end. Again, remember that CMHC requires that you have 25% of the loan amount of the project cost in net equity. So again, in a hypothetical situation where you have a $1 million property like here, and you spend $2 million hard and soft, and you have a project cost of $3 million, CMHC wants to see that you've got 25% of that $3 million, in this case, $750,000 is net equity, net value outside of the project. So again, you see how having these numbers in this kind of pro forma can allow you to determine that quite quickly and quite definitively, instead of guessing it, a guessing game. The other thing I just want to mention is if we can go and look at the project cost versus the valuation on the far left there. So you can see that, yeah. So you can see that we've got a total project cost of 4.3 million, which is to say a project cost of 4 million, but then we throw in the interest reserve. The interest reserve basically is to say, hey, what's the interest on the construction, and add it in. So this way I don't have to pay you every month. It's already factored in. So the construction loan will be 4 million. You throw the interest, it brings it up to 4.3 million. But if you compare the 4.3 million with what it's actually worth once we complete it, and the valuation is down below, you can see the valuation is 4.3. So this is what I was saying earlier before, that this is not, these missing middle are not typically the development deal where you're building and you're expecting to see a significant pop, a significant capital appreciation at the end. That's not really the driving factor where clients are going ahead with these types of projects. They're small, You're paying a big chunk of cash for the land because we're in Toronto. As you leave Toronto and move to the outlying areas, you'll see that you're able to buy land cheaper, and you'll see that you're getting away from the 85% loan to cost, closer to 90, 95% loan to cost. So that's where it becomes more attractive from that perspective. But of course, Toronto being a much larger city, this is where we have lower cap rates, and you're seeing potentially much bigger swings in capital appreciation when the market does take off. So I will now close this one and go back to the other screen I had before just to continue. So this is where we left off in the presentation. I just wanted to continue from here. So in terms of what we offer, again, as I mentioned, and reason why I mentioned the 4 elements of TESA is that we're able to pull in information from working with clients on the acquisition side, on the financing side, on the actual entitlement and construction side, and the skeleton side, to bring those real numbers into the feasibility analysis. And in creating this feasibility analysis, which is very representative of real numbers that one can expect if they decide to go to the next step. So in our offering, we have 3 different options that clients can engage us if they want to go through with this feasibility analysis. The easiest one is as of right, where you're basically saying, whatever the city says I can build, let's go with the low-lying fruit. Let's do the easy peasy. And this one here is at 2490 plus HST. It takes about 2 to 3 weeks to get it done, and this is basically complying with current zoning. We're going to go for no or very minor variance, and it's aimed at the most cost-effective and fastest approval time. Why would you do this? Well, speed to market is key, because if you can get it completed as quickly as possible, you're going to minimize your carrying costs, etc., and you're also minimizing your risk from the perspective. Who knows what a year, 2 years from now will bear, right? So if you can finish this in 2 years as opposed to 3 or 4 years, because you're mired with the city in long committee of adjustments, etc., you can see how a lot of our clients who are first timers opt to go for option number 1. If it makes sense that you go for some sort of an optimal variance, then it's slightly more expensive, 2990 plus HST, and this is where we're seeing more and more of our clients opt, because they're rationalizing from our financial analysis that it makes sense to spend a little bit more time, a little bit more money, because it leads to a significantly improved financial analysis through, going from 4 to 6 units or what have you. Option 3, we include it, but it's not one that clients opt. Predominantly, our clients are going for option 1 or option 2. So that takes us to the conclusion of the presentation, of the webinar. If this is something that would be of interest to you, we encourage you to take a snapshot of the scan the QR code, or fill in on the left-hand side. We're happy to give you a free 30-minute consultation to review any project that you're working on right now, or maybe you're just wondering, should I even get into this business? We're happy to have that conversation with you. Again, 2 ways to get hold of us. I've offered you my email address as well as my cell phone information there. I'm going to go now to the chat, and if there are any questions, I will answer them. So we have a question here. Curious to know if it will be a residential mortgage during initial land acquisition, then convert to CMHC loan for construction. Yeah, so CMHC basically is helping you with 2 of the 3 different milestones of missing middle development. Again, number 1, you have to acquire the land. Number 2, you have to build it. Number 3 is a takeout. And CMHC is offering us assistance with number 2 and number 3, the construction, financing, and the takeout. The land acquisition, we're basically left to our own devices. 1, we can go out and go through a traditional bank And if we basically claim it as a principal residence, in a way, that's what kind of mortgage fraud, because you're not going to live in it, and they're lending it to you because they think you're going to live on it. And part of the bank's collateral is the actual building. If you now secretly go and knock it down, you're taking away some of their collateral. So that's kind of a no-no. So there are certain credit unions, for example, out there that do like this type of business. Slightly higher interest rate. I don't know, I'm going to guess it's around 6 or 7% right now, but they will gladly do these kind of financing. Once you have that in place, the rest we can assist with a CMHC. But again, as I mentioned, not all our clients are going with CMHC for the construction financing, for the simple reason that it is rather bureaucratic and long-winded to get that CMHC financing. Benefit of the CMHC construction financing is that even though it takes longer, once you get it, any changes that CMHC might make to, say, for example, the energy efficiency program, you're safe, you're grandfathered, and it doesn't affect you. Whereas if you go through a private or conventional and they make that change, you now potentially are out that benefit, right? So these are the pros and cons of doing that. Do credit union type financing require higher down payment? Yes. So in a house purchase, you're probably looking at 80-20, 20% down, 80% mortgage. With these, you'll probably be looking more like 70-30 or 65-35. Where is the LSF product made? So we have a facility in North York, DVP and Finch roughly, and we have a facility there that we can assist if this is something that you are looking to get a quote on. Happy to send me an email and I'll put you in touch with our LSF team. If this is something you would be interested in taking a look at the facility, we do host tours every now and then. So if that's something that would be of interest to you, again, shoot me a quick email. I'll let you know when the next one is. Does TESA Capital help clients in raising equity capital to meet the 20-30% equity requirements, or just debt financing? At this point, we're just helping with debt financing, equity capital, raising equity. That brings into security exchange rules, etc. We're not licensed to do that, so we only help on the financing side. And again, we can help on all three milestones. It's all three critical elements of the financing side: acquisition, construction, and takeout. I think that was the last of the questions. So if there aren't any other questions, just want to thank you all for your participation and for your questions and your interest. Great group as always, and I appreciate your interest. I think this is going to be definitely Toronto's next stage of evolution, because this is something that we haven't done for decades, and we've seen more changes in the last 2 or 3 years since 2023 with Bill 23 than we have in the last few decades, and we are in dire need of more purpose-built rentals. And I think this is just we're just scratching the surface. And regrettably, the economy and the way the real estate market is happening right now, we see that there's some hesitation. But I think those that can see past the short-term pain and are seeing the long-term need that is built in, given that we're adding 1 billion people to this planet every year, I think those that are bold will be well rewarded. So again, thank you for your participation, and I look forward to talking to you at some point. Have a good night.